everyone. Welcome in to Tax Tuesday. My name is Amanda Winalda. This is
Elliot Thomas.
We're both attorneys, both tax attorneys.
Yes.
So get ready for a good time. We're going to be talking about taxes today. We're bringing tax knowledge to the masses. And so why don't we, giving everyone a chance to get onto this call, throw up into chat where you're from. We like to see where everyone's coming from. We usually have several people from
all over. We got Colorado, used to live there, Maryland, Iowa. Woo.
Iowa boy right here.
Las Vegas, we like that.
We love Vegas. We're based out of Vegas. Broadcasting live from Studio 210 in the Anderson Advisors building.
Fabulous Las Vegas.
Chicago, love it. San Jose, I was just out in San Jose. Did you know it is the 20th year of Major League Soccer? Anyway, we were out in San Jose to celebrate that.
Oh, congrats.
Torrance, Salt Lake. I was just out in Salt Lake for some kids' soccer games.
Do they have the World Cup? Is that starting? Is that
2026?
Oh, still got a little bit. Okay,
Yeah,
gotta get those tickets though. Gotta get the tickets now.
They're kind of expensive. I don't know.
Yeah, maybe
we're gonna have to get these people some tax savings so they can afford World Cup
there
tickets.
It is. Oh, Hawkeye! Everybody's a Hawkeye in Iowa.
Is everyone?
Just
nice.
about.
Logan, Utah.
My friends went to Iowa State though. But anyway.
Friends.
Have a couple.
I have a couple. All right. Well, thank you for joining us from wherever you are in the United States or even in the world. These are the rules. Tax Tuesday comes with rules. This is a live Q&A, so you can throw your questions into the Q&A. The chat is for if you're having any sort of technical difficulties, but if you want to have your tax questions answered, we've got a great group. Why don't you tell us who's here?
Yes, we got, it starts with Amanda. We know that. We got Patty. We got Dutch. Harry, one of our tax advisors. We got Jared. It's not letting me move down here. Jeffrey, Marie, Rachel, Ross, and Troy. I think Troy is doing YouTube, as I recall.
Yep, Troy's going to be answering questions on YouTube as well if you're joining us live there. So go ahead and throw your questions into the Q&A. We'll get those answered for you. This runs about an hour 15. We usually answer close to 100, 200 questions usually. So if you don't want to put your question in a Q&A and you want to wait longer for an answer, you can email us at taxtuesday@andersonadvisors.com. That is where we gather the questions that we're going to be talking about today and every Tax Tuesday. Elliot has the honor, yes, of going through all of those. So flood him in. And he puts together a curated list of tax questions.
Especially for you folks.
Yes, just for you guys.
Our guests.
Yeah, if you need a more detailed response than what we're doing today live or in the Q&A, why don't you consider becoming an Anderson client? As a Platinum client, you have unlimited access to our tax and our attorney team. So this is designed to be fast, fun, educational.
Yes.
We love educating people. Educated clients make the best clients.
They really do.
They really do. We like it when you ask us the tough questions. So we're going to go over the questions and then we will answer them. So I'll start off. First one, I own an LLC that I use to purchase a single family house to fix and flip. Can I use a 1031 exchange to save on taxes while I look for my next property? If not, could you suggest a few tax saving strategies for managing income fluctuations?
Fantastic question. Next question. I have 5 years left of depreciation on a rental property. I was looking to do a 1031 exchange, but didn't realize that depreciation schedule remains. We'll cover what that means. I'm unclear what my tax plan strategy should be, as I was looking to buy another one anyway. Can I do a 1031 to defer some capital gains, but no longer depreciate, and or buy another property and get a new depreciation schedule for that one? Toby mentions defer until you die, but most of us will live with investments for 27 and a half years. Please clarify.
All right. So that's number 2 in our 1031 exchange series. We've got one more 1031 exchange question. What are some of the rules regarding a 1031 exchange when selling a rental home in one state, but purchasing the replacement property in another state? So we're going to do a deep dive with these 3 into 1031 exchanges today.
Yes.
What else we got, Elliot?
Then we're going to shift Or two, if I buy a car with weight of more than 6,000 pounds for my newly incorporated business and have not earned any income in the first year of business, can I use it to reduce taxes against my spouse's W-2 income?
I love it. I love it. I own a rental house and a management corporation, which is a C Corp. How do I deduct mileage for my rental activity? There's actually two answers to this question, huh? Let's say that from my house to the rental is 100 miles round trip, and for 2025 taxes, the mileage deduction is 70 cents a mile. So am I due $70 for mileage, or do I deduct the expense? How do I deduct the expense if I don't receive any cash for the mileage? And in this type of structure, which we'll go into, which entity actually takes the deduction? We're going to get all those questions answered for you.
Yeah, that was a great question. There's so many things, and we're maybe
lot packed in
confusing a
there.
little bit in there, so we'll sort that all out for you. Next one, how does one qualify for 0% capital gains? Gotta love that, paying no tax whatsoever.
0% is my favorite percent.
Right? Can we do that? Yes, we can. Starting in 2025, single filers can qualify for 0% long-term capital gains rate with taxable income of $48,350 or less. Married couples filing joint are eligible with $96,700 or less. However, taxable income is significantly lower than your gross earnings. So we'll tear that apart.
That's true. That's a couple of educated question askers
You're
there.
right.
They know the limits, the income thresholds,
Yep.
the reimbursement. All right.
Proud of our clients.
Yeah.
Yeah. Good
I
job.
invested in an ATM syndication. It was a Ponzi scheme. Wah, wah. And all investment was lost. The K-1s I received for previous years were fraudulent. How do I file my taxes for those years that I received a fraudulent K-1? That's no fun, but
Right, not fun.
there
but-
is a little bit of a silver lining there. We'll get into that.
Yes. What are the tax implications of doing a deed in lieu for a timeshare?
Short and sweet.
Yep.
I like it. What happens to your real estate if, when you move outside of the country? Is it deemed a disposition? We're going to assume you mean the United States,
Yes.
because that's where we are.
Yep. And that's our questions.
All right. So you heard Toby mentioned in one of our previous questions. Here he is. The man, the myth, the legend, Toby Mathis. This is if you're joining us on YouTube, you're on his channel. So if you're just came across us, go ahead and click that subscribe button. You'll be able to get notifications. We do Tax Tuesday every other Tuesday throughout the year. We've also got Clint Coons, which is the other founding partner of Anderson Business Advisors. He focuses more on real estate and asset protection. Both of them YouTube influencers, get those YouTube awards lined in their walls. Just have been doing this, putting out free education for decades, over a decade.
2 decades.
Check it out. Also, if you would like to join us live to hear all about tax and asset protection, we hold a live workshop. You can use this code, QR code. Just hold up your camera right there, click on it. $99.
Here in Vegas.
Here in Vegas, June 26th through 28th.
And there might be some deals. I heard they're dropping the prices on the strip.
The live.
Yeah.
Oh, really? On the strip?
Yeah, because of travel. Summer travel's down.
Oh, yeah. Some
So it
good
might be some
summer
good deals.
travel deals if you want to.
So come to Vegas.
Yeah. Then
See us.
hang out with us. And we give out some pretty good deals at our events, too.
Yes.
Pretty good deals.
A lot of good tax information we give.
We do. We do.
Can't beat that.
If you can't commit to a whole weekend, join us on a Saturday for our tax and asset protection event. So 1-day webinar, typically from 9 Pacific to about 4:30 Pacific. Tax and asset protection in the morning, estate planning in the afternoon. It's a good time. The next ones are June 21st, then June 28th, and then, our live one. So come out and see us either for 3 whole days, 1 whole day, whatever, however much you need. We've got something for you.
Go to a mall.
Yeah, go to a mall. You know, people actually come to our webinars 3-4 times.
I believe it. You always got to check
You
back
always
in.
get a little, it's often drinking from a fire hose. Sometimes these events are, but if you keep coming back, you just get a little bit more each time.
Turns into a garden hose. A little bit less.
All right. I own an LLC that I use to purchase a single-family house to fix and flip. Can I use a 1031 exchange to save on taxes while I look for my next property? If not, could you suggest a few tax-saving strategies for managing income fluctuations? So I think we start off by
What
What is a fix and flip?
You tell us.
Stop laughing. We were joking earlier that a fix and flip is when you fix your hair and then you flip it. But that's not true. It's real estate. So fix and flip is when you purchase a property with the intention to remodel it, add some value. Maybe you're just updating the finishes. Maybe you're doing a completely adding on a new bedroom, adding some value, and then you're flipping it. You are turning around and selling it either to a homeowner or to another investor who's potentially turning it into rental, short-term rental, whatever. So that is a fix and flip. Elliot, what is a 1031 exchange?
1031 exchange. The principle here is that you've had property that you've used in a trade or business or as an investment, and now maybe we're going to sell it. We're thinking probably longer term holding and use of it in that business. A little bit different than the fix and flip that Amanda was talking about, but nonetheless, we've had this maybe as a rental property or something of that nature, and now we want to sell it. Well, if we sell it, it's gone up in value. We've had some depreciation, our adjusted basis has gone down. All of that means probably we're paying taxes if we sell. 1031 is a way that the government says, at least with real estate, if you go out and you buy a new property, we call it a replacement property, within certain time constraints, et cetera, well, then we'll just go ahead and defer that tax. You don't have to pay any tax on it. So it's a really great incentive to defer. Again, we're saying defer. That doesn't mean you get rid of the taxes. We're just kicking them down the line. And that's kind of the idea. And so here we're going to look for, kind of tear that apart and see when we can use this and when we can't. The fix and flip that Amanda was talking about, though, that's kind of an ordinary business operation. That ordinary type of income, that's inventory, we can't use that on a 1031. We can't use inventory. It's got to be used as a trade or business, which means, again, a rental property, or maybe we just held it as an investment. But what we weren't doing is, flipping it up, fixing it up, and then flipping the property. So we have a situation here where we can't do a 1031 for a fix and flip. It's ordinary income, but how could we maybe have some tax strategies with that? Well, because it's ordinary income, we're going to suggest doing it in a corporation, maybe an S or a C corporation. That's built for ordinary income. We now do our fix and flip in there. Let's say we earned $100. We do it in an S corp or a C corporation. They're geared for that. Then we can do other things like reimbursements. We can have an accountable plan, maybe get reimbursed for our administrative office. We could do maybe the 288 corporate meetings, or possibly even a medical reimbursement with a C corporation. If it's an S corporation, we can also maybe save on employment tax, because with ordinary income on a fix and flip, it's not only subject to 100% of all of it with ordinary income tax rates, but you're going to get hit with employment taxes. So we have that to contend with as well. So a lot of reasons why we want to do the flip in a corporation, but we're not going to be able to do a 1031. We can't defer that tax. So we're going to look for those other avenues to try and eat up that taxable income.
You just flew right through that, didn't you? So long story short, you cannot do a 1031 exchange with fix and flip. If you're a flipper, the properties are not considered investments. They're inventory. You can do a 1031 exchange for your investment real estate, but not for your inventory. So our solutions here are to use an entity. Entities are sort of the bread and butter of how we are saving on taxes. So if we have two options, a C Corp or an S Corp. So with the C Corps have a flat 21% tax rate. So right there, if your normal ordinary income tax rate is above 21% and you do the flip, you're paying a lot more tax. If you do the flip within your C Corp, you've automatically already saved some tax. Then we're able to pull money out of the corp tax-free. And that's what Elliot was talking about in terms of an accountable plan, which is basically a reimbursement plan, your mileage, your administrative office, your phone, your internet, all of that stuff, the use of your home. Then we have Section 280A. This is often called the Augusta Rule, and it's where you can rent your home to your corp and then pay yourself a rental income, a day rate. You can do that up to 14 times a year, and that's not taxable income to you, but these things are deductions to the corp. So it's taking what you would normally have paid at 21%, and we're reducing that total income, right? And then the last one in the C Corp is 105B medical plan. And that's where you can essentially reimburse yourself, again, tax-free, for qualified medical expenses. So these three things together can have quite an impact in terms of reducing the taxable income in the corp, which is already hopefully a lower tax rate than what you would hit normally on your personal tax return. Now in the S Corp, we're looking at, let's say, we're looking at paying a salary versus getting a distribution. Because in an S Corp, if you sell a property, 100% of it's subject to what?
All of it's subject to income tax. We're not going to get around that one.
Income tax. But we're also worried about self-employment tax or payroll taxes, right? So the portion that you pay yourself as a reasonable salary, because S Corps require a reasonable salary, is going to be subject to that 15.3 payroll tax. But the portion that you take as a distribution won't be. So we're already saving a lot of money here.
Tons.
Versus doing it in, let's say, a disregarded LLC. Sell your property for $100K. Already you're going to be paying $15,300 in just self-employment tax on top of your normal tax rate. So using entities and also the type of entity or the tax treatment of that entity is going to have a big impact. Now, I'd asked you this earlier when we were talking about this. Why can't I do an installment sale, a seller financing? Why can't I do that?
And you can, is the proper answer. You can do an installment sale. However, you got to pay all your tax in the year of sale. So we can't defer the tax, which is really why everybody does an installment sale to begin with. So that's why often I mistakenly say that you can't do an installment. You can, but you have to pay all the tax up front.
Yeah, so really not quite a benefit there if you're doing any sort of seller financing situation with them.
But just as you laid out here, just getting back, you're not only going to be able to attack the self-employment tax for the S corporation because you're only going to pay that on a reasonable wage, but you got those same accountable plan, same 280A that we have in the C corp. Excuse me, but just depending on what we have going on, maybe we have some medical, well then we can use that C corp that Amanda put up here. We got the accountable plan, 280A, and that medical reimbursement. All just great ways to sit there and mitigate that tax burden that we're going to get from the flipping, because remember, it's ordinary income. We can't do our 1031 exchange. But what if it wasn't a flip and we had the 1031? We didn't talk too much. We really talked about the flipping, but the 1031, again, as I quickly brushed through, it's a way of, if we sell a property that we use as a rental, let's say, and we pick up a new one, maybe the IRS is going to let us defer. Now, there's a lot of little rules to that. First of all, within 45 days of having sold, you have to list out which ones you're going to pick up, the replacement properties. And then you have to close on the whole deal within 180 total days. So we have some rules like that. And because we have a couple questions coming up about the 1031, just to lay a little more groundwork on it, some primary things to think about with the 1031. Number one, again, for the deferral, the amount of deferred income, income tax liability, when you sell the property, let's say we sold it for $100, we had an adjusted basis of $25, your gain's going to be $75. So we want to know how to calculate our gain. It's your sales price less your adjusted basis, that's the gain. And if we want to defer all that gain, we have to pick up a property, the replacement property, that's equal or greater in the value, the fair market value, and we have to equal or pick up more debt. Those are the two things. If we meet those criteria, we're going to be able to defer 100% of that tax. Number three, we always want to be aware, people get asked us all the time, it's a great question. When I get that new replacement property, what's my basis? Well, the basis is going to be the purchase price of the new property, less that deferred gain that we deferred from the sale of the other property. That becomes our new basis. And so there's a little things that we want to keep in the back of our mind. It's going to help us with these future questions here.
Yeah, it's not just about saving on taxes, but what did you say? It's not if it's not a surprise.
I don't remember. I remember I had a great quote, though.
You did.
So you can all laugh because it was a great quote.
Quoted Elliot Thomas. It's a little easier to write that check when you know how much ahead of time how much that check's going to be.
Oh, yeah. It's coming back to me.
It's coming back to you. It's coming back to you. All right. I have 5 years left of depreciation on a rental. I was looking into 1031 exchange, but didn't realize that the depreciation schedule remains. I'm unclear in what my tax planning strategy should be, as I was looking to buy another property anyway. Can I do a 1031 to defer capital gains but no longer depreciate, and or buy another property and get a new depreciation schedule for that one? Toby mentions defer, defer, defer till you die, or swap till you drop. But most of us will live with investments for 27 and a half years. Please clarify. So depreciation, what is it? What is this 27 and a half years? Why do I care?
Right. So when we deal with a rental property, which we are here in a 1031, again, we use it in a trade or business, we can depreciate. We want to be able to depreciate. We aren't allowed just to deduct the cost of it right up front. So the IRS says, well, in the case of, let's say, a single family rental, you can depreciate it over 27 and a half years. And that's what we call straight line. Same amount every year for 27 and a half years. Or if it's commercial, it's 39 years. But that's the idea of what's going on here. And so what our questioner is asking here is like, well, if I fully depreciate or if I depreciate most of it, what really goes on with this whole depreciation thing in the 1031? Now, here they recognize that I didn't realize at first that depreciation schedule remains. What's going on there? That's what we call carryover basis. So again, we're starting with a property. Amanda's going to sell her rental. Okay, we call that the relinquished property. She still has an adjusted basis in our situation here. So in other words, she bought for $100 maybe, and she's depreciated most of it. I think that's probably your red lines there.
Yeah, this is depreciated, the depreciated portion.
Yes.
And then this portion that carries over is
The remaining adjusted basis. So she
carryover basis, right?
Yep.
Look at me.
And that was the part that she didn't depreciate on the relinquished property she gave up. But then you have this other box up top, and that's going to be, yes, the excess basis. And that's going to be, well, what if you paid a lot more for this new property? It was $1 million building. What you gave up was $250,000. That excess, it's got to be depreciated somewhere, and we call it excess basis, and they will portion it out amongst the asset to be depreciated. Well, what happens? How do we depreciate it as far as number of years, et cetera, et cetera? Well, the carryover portion, we just carry it on how we were doing it before.
5 years left.
Yep, so you're just doing
5 years left.
Same thing. 5 years just continues right there. But that excess, IRS says, well, you start all new with that.
Brand new.
Exactly. So if it's going to be 27 and a half years or 39 if it's commercial, you always take that. And again, here we just have one asset in ours. So you could have multiple buildings. Well, then you have to portion it out. A little more confusing there, but the code's taking care of it. So we have pathways. But we have one kind of fly in the ointment. What if on the property we sold, we'd done a cost segregation?
Well, before we get there, I'm doing 2 lines of depreciation now, 5 years and 27. Can I just smush them together?
The IRS,
that's a tax term, smush it together.
Exactly, and we do have a smush together provision in the code. The IRS says, well, we know that could be kind of confusing tracking both of those, so we'll give you another option. You can take that carryover basis and put it into the pile of the excess basis, and now you just do all of it at a new 27 and a half years or 39 if it's commercial. So you can do that, but what they won't let us do is the opposite. Why? Because that would be speeding it up.
Yeah.
They don't let us do that.
Yeah. Okay, so now to cost seg. So what is a cost segregation analysis? Why do people use it? What are the benefits?
Right. So again, we talk about this straight line, very limiting or very boring. So the IRS says, well, you can have a specialist come in and look at your building and break it up into other pieces of property. And the example was, we always talk about, well, we have carpet. That's actually 5-year property. Here in this building, we have lots of carpet, some of it better than others, depending where you walk around in the building. But nonetheless, it's 5-year property. We have lights, things like that might be 7, 15, what have you. And then there's the foundation, which is, because this is a commercial building, it'd be 39 years. The studiers come in and they do this cost segregation study and say, well, let's break it out into these pieces. And anything that's under 20 years or and under is what we call 1245. It's called personal tangible property, 1245 property. And the rest is 1250 property. That's what it was before you broke it. Whatever's left as, like, say, the foundation, your 27 and a half or your 39 year retains its 1250 carry. And those are code sections, 1250 and 1245. So we've done this study and we broke it out. Now, if we'd done that on Amanda's property that she sold, the relinquished property, she's broken it into 1250 and 1245 with a cost seg. Well, then the new property, we have to do a cost seg for. We got to have as much or more 1245 property. We got to have as much or more 1250 property. Otherwise, we're going to have some depreciation recapture.
Yeah,
so
which is ordinary income rates.
For the 1245, exactly right. Yeah, no benefit there. So yeah, what I'm telling you now is there's a situation where not only may you not be able to defer, not only will it not get capital gains, long-term capital gains treatment at maybe 0%, like we're talking about, or 20%, but now it's going to be ordinary rates, no fun. So we want to be aware of that. If you had done a cost seg, you have to mirror or have more of those particular properties, the 1250 and the 1245, after a study.
Yeah. So I have a rental property. I do a cost segregation analysis. I'm doing a 1031 exchange. I'm not going to go and do a cost seg on a property before I've actually bought it. So I don't know if the 1245 and the 1250 property are going to match up.
It is. So we had.
So
it's a
what's
problem.
a way for me to kind of shorthand it?
Yeah, protect. Well, we were talking about this a little bit. You know, maybe if you go out, was it the mobile home parks? Mobile home parks are kind of known, or gas stations, the 7-Eleven rule, they're known for having a lot of 1245 property, and that's why they're very popular. So in this situation, while you're not required for the 1031 purposes to get a similar property, you may want to think about it because you know it has a lot of 1245 capability there. That might be the wise way. You're going to be looking for that kind of analysis.
Like more similar properties. So if you're going from a mobile home park to maybe a warehouse, that 1245, 1250 property ratio is going to be off because they're so different. Now you can do a 1031.
You can.
From apartment complex to a warehouse to a
Yes.
mobile home park, but just be aware that there's some complicated tax issues on the back end there.
Yeah,
if you've done that cost seg.
Yeah, so always helps talk to your peoples, you know, that know this stuff and make sure.
Peeps, your tax peeps.
Exactly.
All right, last 1031 question. What are some of the rules regarding a 1031 exchange when selling a rental home in one state but purchasing the replacement in another state?
So
You can do that.
absolutely you can. There's no prohibition to doing this. And most states are coupled, or they follow what we call the federal rules on this, so you don't even need to worry about it. Nothing changes if you go from one state to another. However,
But 50 states, they're not all on the same page, are they?
They never are. But there's 4 states that have what we call a clawback: California, Oregon, Montana, MT, yeah, and then Massachusetts, MA.
MA.
Yeah.
Don't say MA like you weren't confident that I knew that it was MA. I was just drawing
Let's see
slowly.
if you don't have an MS or something like that. You know, no, that's Mississippi.
Clawback. So a clawback.
Clawback.
That means they come after you.
That's exactly what it is. They come fiercely after you for their money. So the example we always see, you know, you always read this online and whatever, and we use it. Let's say you had a property in California, you sold it, and you picked up one in Texas. So many people like to go there because there's no state tax. Now, at that point, California doesn't have a problem. But what if you later on sell that property, even a 1031, that Texas property in for maybe a Louisiana property or something like that? Well, now they have a problem. They say, well, you gave away that first deferment. Now we want our tax back in California. So you had to pay the state tax that you were originally deferred. Why do we care? Because remember, you're probably not getting a whole lot of cash on these 1031s because anything that you do take for cash is boot, which means it's taxable. So you have to be aware of that. And California does have that clawback. Now, if you just retained that Texas property and never did anything else, you don't have to worry about it. Well, how do they track it? Well, California and Oregon actually have annual reporting. They have forms, specific state forms for this, that you have to report. If you're from California, you're probably aware of this because we deal with it a lot. You have to every year send this form in to, I can't remember, I want to say it's like the 3348 or something like that, Franchise Tax Board form. And you're telling them, hey, I didn't sell that property yet. I didn't sell that property yet. If you failed to do that, then they're going to make you pay the taxes, even if you didn't sell. So those 2 states in particular, California, Oregon, remember every year you got to file that form. What about Montana, Massachusetts? It's a little bit more on the, let's be truthful about it if you sold. But you don't,
Code.
right, yeah, and you don't want to play games with these states on these things, but that's what we have going on. That is one thing that we have to worry about when going from one state to another, watching out for the clawback. Again, the other multitude of states, you don't have to worry about this.
Yeah. So you get 1 degree of separation.
Yes, ma'am.
You get to defer it for the 1031 exchange, and then when you sell that replacement property, you at least have to pay the state tax, even if you're doing another 1031 exchange.
Correct. Yep. So that is our 1031.
They'll wait.
Coverage.
So patient of them. They'll wait a little while, but not forever for their
Right.
tax.
Oh, yes.
All right. If I buy a car with a weight of more than 6,000 pounds for my newly incorporated business and have not earned any income in the first year, can I use it to reduce against my spouse's W-2 income? So let's talk about this 6,000 pounds requirement. So this is typically the heavy SUV.
It is.
And so how do we buy a car, it's over 6,000 pounds. What are the requirements to fully deduct that from my income?
All right, so yeah, it's the heavy SUV rule here. So we are talking SUVs. We're not just talking any car. It's usually an SUV. There's specific category in the code for this. This is not what we're going to go over today. It's not applicable for, maybe just a sedan or something like that. But this allows you basically, for simplicity, the best way to get the most deduction for this vehicle. Now, yes, we have to use it at least 50% in our business. That's a big key, okay? If we don't, and maybe we have it in a corporation or something like that, that other personal use becomes taxable income to us. So we're going the wrong direction. We're not saving. Yeah,
we're in reverse.
And it's not just
We're being dry.
right. It's not just, but it's like wages, which means it could be subject to
Also payroll tax.
yeah, all that. So it's certainly income tax. So we got to watch out for that. At least 50% business use. Now, I'm going to get kind of picky here. We talk about if we incorporate a business. That means to me C corp or S corporation.
Well, how are we deducting it?
If it's on a C corp.
Okay.
I just want to point out that is a separate taxpayer. So if we had a $100,000 car and we deducted the whole thing, none of that, it's not going to have $1 effect on your spouse's W-2 because it's a separate taxpayer.
Not getting you where you want to be.
No. If it's an S corporation, it's a flow-through entity. Well, yes, that could, provided we meet all the things that we're going to go through, then we might be able to take a deduction. So I want to hit that first. So C Corp's not going to help us. What if it was a sole proprietorship? Well, we still have that rule, man, to put up there, that 50% business use rule. It's just there you wouldn't have taxable income for the personal use. You just wouldn't have a deduction for that amount. So those are kind of the first things laying it out there. I'm going to go with under the concept of maybe using an S corporation here. And one other thing with this business that often I know I skip over all the time on this. I just assume we're looking for how much we can deduct against our spouse's income. Here's the calculation, et cetera. We're going to go through that. But what we have to step back for a second, you have to be materially participating in that business. We talk about that all the time with the real estate, if we're going for rep status or short-term rental. Well, remember, those are a subset category of Section 469 passive loss rules. So any business you got to materially participate in. And so that's the same rule here, same Section 469. You have to materially participate, and we've gone through those rules so many times, but basically you're putting more time than anybody else in the business, or over 100 hours more than anybody else, or at least 500 hours. Those are some of the tests for material participation. Now, we get all that preliminary work out of the way. We got an SUV, 6,000 pounds. How can we use it? We haven't earned any income. That's an important factor here.
Yep.
Because we have three types of deduction here in kind of the depreciation area. First is 179. Okay, we'll let Amanda get that on there. Second is going to be your bonus depreciation. And the third is just going to be your basically your makers, we call it, or straight line kind of. Three forms. Now, the 179 here becomes critical with the question here. I didn't earn any income. We can't use 179 to create a loss. And we do go in this order, 179 bonus and then makers. So if in this case here, we didn't earn any income, so we can't use 179. But we will go through an example where we did. But here, we'll start off with what we did. Let's say we bought the car, $100,000, purchase price of a car. What we'll be able to do without the 179, we can take bonus. And in 2025, our bonus depreciation is 40%. So we can take that 100,000 times 40%. We get 40,000. That's our immediate bonus deduction. That leaves us with $60,000. At which case we can take, it's a 5-year property, so we can take 20% of that, which is another $12,000. We can subtract out. That gives us a total depreciation of 52, or remaining 48,000, depending on how you look at it. And then we would just divide the 48, at that case, by 5.
5-year property.
Yeah, and I'm sorry, I guess I didn't do that calculation. So
Well,
that amount is what we would take as
then
makers.
that equals something.
It does. It does. And we'll do that real quick here, a little bit under 10,000.
So the makers is what percentage?
It's going to be 20% or it's 5 years.
20%.
So it looks 9,600. So all of that is going to be what we can deduct with the without the 179 if we didn't have any gain. And so if we had no income, all of that amount is going to be an automatic loss against the spouse's W-2 income here. So that will work for us as long as we materially participated. It's an S corporation, assuming we have shareholder basis. That's another little thing. But if you put the money in to buy the car, you got shareholder basis, so no problem. So we'd have a loss of about 48,000 here, and that would be all deductible.
48 plus the 96, right? 48.
Oh, I'm sorry. I'm sorry. I messed up. The 12,000 is our makers. My apologies. Sorry. So 48,000. 48,000 is the proper deduction there. So I guess
All
I did
right.
that. Now, that was all again if we had no income. What if we did have enough income to maybe do the 179? 179 is a specific amount that the government has said that you can do, and that's on a
Let's
chart.
pause.
Yeah,
48,000 against your W-2 is big time.
It is, especially depending on your bracket. If you're not
Yeah.
the jacket, 37%. Yeah.
It could pull you down to a lower tax bracket. It could saving 48,000 just by purchasing a vehicle that you likely need in your business anyway is a huge tax deduction.
And we're going to see in one of our future questions coming up here, what if that costs below a certain amount? Maybe we have some like capital gains. We might have a way to combine this for a really great tax savings. And we'll allude back to this when we get there. It's one of our future questions coming up here. But yeah, all kinds of good stuff.
So what if we are making some money in this company? Then how does the being able to take 179 change it?
Right. So the government says in 2025 that you can take 31,300, 179. So in other words, we're going to start with 100,000 again. Now you can take away, subtract out 31,300 for a heavy SUV in 2025. That comes out to 68,700. 68,700 we're going to take now times our bonus 40%. That is going to be 27,480.
All right, I'm running out of room here.
And
So
then, okay, then I'll just
minus
give you the numbers.
40 and then minus 12 again, right?
Correct. When all that is said and done, your total depreciation with 179 is going to be $67,024 immediate deduction. That's pretty steep.
That's huge. Okay, so how much, in order to use Section 179 and get this $31,300 loss, how much money do I have to make in my company? I have to make at least $31,300?
Correct. You'd have to have that, after all other expenses and things like that. Well, now we're just to this particular calculation. We'd have to have at least 31.3 in order to take the 179, and then we can hit our bonus, and then we can do our makers.
Oof, so good.
Yes, big deduction. So that's how we get it. Again, we got to materially participate. We always have to. It sounds so people just blow it away. Don't worry, I'm doing the business. I'm materially participating. But you have to make sure you're materially participating. Otherwise, all this just goes out the window.
Yeah, you can't just be the money partner, as they say.
Exactly.
And get that new truck.
Right. Exactly right. And at least 50% of business. That's a critical component that Amanda started out with up here.
Or else it's taxable income to you.
Mm-hmm. Yep.
All right.
There
This
we
is
go.
on top of the mileage you get to take, too.
Yes, yeah, we got mileage as well. Mileage takes depreciation into account too. So we wouldn't, in this particular situation, we wouldn't have mileage on this one.
No.
No, yeah.
All right.
But still, 67,000. I think you're not hurting. It's a good deduction.
Great investment.
Yes.
All right. I own a rental house and a management C Corp. How do I deduct mileage for my rental activity? Mileage. It's like we just...
Mm-hmm.
Let's say that from my house to the rental unit is 100 miles round trip, and for 2025 it's 70 cents per mile. So does this person get $70 for mileage? And then logistically, how do they deduct the expense if they don't receive any cash? So...
Right, lots going on here. Here we're going with our traditional structure. It looks like we have a rental LLC maybe and a management C Corp.
yeah, so usually we'll have a holding company, and then a property LLC, and then the C Corp is a property management company. And so there is a property management agreement, and a percentage of whatever rents are coming through here is then being paid over to the corp to manage the property, whether it's doing regular property management, putting a tenant in, calling repair people, or it's more of an asset manager managing the LLC itself, doing its bookkeeping, keeping everything straight. We're looking usually 10 to 12% going over here. And that's how we're getting income into the corporation. Because if I'm just like at my house and driving over to my rental, can I deduct that mileage if I don't have a structure? If I'm just a person with a rental property and I'm driving over there to collect the check, can I deduct that?
You're being very accusatory.
Can I?
No, she's right. You can't.
No,
Okay.
you cannot.
So even though some taxpayers may go ahead and put that mileage as a deduction, I don't know who would do that, but some may.
Not this guy.
No, but you're not allowed to do that under the code because you don't have an office. That is considered a commute by the IRS. Just like when I drive into Anderson, I can't deduct that mileage. They kind of look at the same way generally, that if you're just leaving your house, going to your rental, you can't deduct that mileage.
Considered a commute.
Although I'm sure a lot of taxpayers maybe probably do deduct that, but.
Well, what if I do have a home office? What if I
Exactly.
carve out a little home office
Yes.
here?
Yes.
And now it's not a commute.
It's exactly right. So then we do have this 100-mile trip times the 70%, or 70 cents per mile. So we got $70 of deduction.
And I'm just taking that against the rental income, Schedule E.
Again, yeah, if we don't have the C corporation, correct. If we're just doing a rental, which we would call Schedule E, that's exactly right.
So if I can get this deduction, why am I using the C Corp? If I could get this deduction anyway, just by having a home office.
Right, great question. So if we use the C corporation, as you pointed out, we're going to shift a little bit. Let's just say 10% to make it easy. Let's say we had $1,000 of rent, and we move 10% over. That's going to be $100 of income into our C Corp, all right? That's going to be a deduction against the rental income of $100. So we have tax savings already. We already have a $100 deduction there for that management fee. So we saved tax. We just shifted the $100 over to our C Corp. But now you can do what's called the accountable plan. We referred to that a little bit earlier for reimbursements. And I, as the employee of the C Corp, can turn in my reimbursement, my $70, my $100 of miles, into my C Corp, so I get $70 paid back to me. The corporation cuts a check for $70 out of that 100. I get to pocket it tax-free.
Tax-free, baby.
Right? So we moved over that money off our personal return. We got tax savings there, and then you got the money back tax-free. So now, let us ask you, do you want to just have your deduction against your rental income? That's nice. Or would you like to have it shifted over where you get the same deduction and you get money in your pocket tax-free? I mean, I'm going to take the cash in the deduction.
Yes.
You know, if I listen to my tax advisor,
Which you do.
right. So that's what, be one's own counsel, I guess, a little bit on some of this. But we have all kinds of things that, just like Amanda put out, the accountable plan, 280A, 105B, to get that $100 out of there, zero taxable income on the C Corp, you just pocket now maybe $100, not just your mileage, but all this other stuff too. In fact, you probably don't have enough money, and that's okay. So then we just manage another property, get more money in there.
Yeah, just get another
Rinse and
property.
repeat.
Yeah.
Exactly right.
Because you do actually have to pay yourself in order for the corporation to take the deduction for mileage. You have to actually not cut yourself a check, but do a transfer. You've got to document everything. So we're looking at a mileage log, an expense report, and you do have to transfer the cash over. If you don't have money in your corp, you can't take the deduction. So how do we solve for that?
Right. So, and I just want to stress what Amanda just said. That's a really important point. We've got to have that cash, that payment. And if we don't have the cash, you can go ahead and put the money in. Put $100 into it. We call it loans from shareholder, or something like that. Or you could, we'll just go with loans from shareholder. So now your corp has the $100. It pays you the reimbursement, whatever it is. It's a cash transaction. Now we get the expense on the C Corp, and again, you got the money right back in your pocket. No harm, no foul.
And that net operating loss can carry forward.
That's correct. Yeah, you have an NOL perhaps on your C Corp. It carries forward. So it's just a snowballing of good events.
Yeah. So if you are doing mileage, accountable plan, 280A, 105B, and your company is just starting, it's not making any money yet, you do have to invest, put some funds into the corp actually take those reimbursements so that you can capture that operating loss. If you just are doing your expense reports, your 280A meetings, and you don't actually pay yourself by the end of the year, those losses are gone.
Yeah.
Can't use them. Can't use them.
I mean, if went into next week, you'll be okay. But we just don't want to have it out there, as some kind of loan on the books for a long time. We gotta get that expensed.
All right. Come see us.
Yes.
June 26th through 28th at our tax and asset protection workshop. It's 3 days of lots of information. Out here in Vegas, people tend to like coming to Vegas.
Yes.
We live here, so do people call you when they're coming to Vegas and go, hey, do you have any hookups
Right.
in Vegas? Like,
Especially-
no, I do not.
Right.
I sleep in my own bed every night out here.
Especially the first 3 years. I think most people, when they move to Vegas, all your friends that some people you haven't talked to forever, they all of a sudden remember you.
Yep.
And everybody wants to come.
Hey,
like,
where should we go out on the strip?
Right, yeah.
You shouldn't.
Are you gonna? Yeah.
Just kidding, Vegas. Come to Vegas. Spend lots of money here. That's how we keep our state taxes at zero.
Exactly.
But come, discover the hidden secrets. America's most successful investors at our tax and asset protection workshop. 3 days here in Vegas. So grab that QR code. Tickets are only $99. Bring a friend. And if you can't commit to 3 whole days, although we wish you would, come out to our one-day seminar from 9 to about 4:30. Tax and asset protection. We hold these every Saturday. So sign up. Come a couple times.
Yeah.
Come multiple times. We have different speakers, different presenters. You always get something a little bit new each time. And it works the same way as this Zoom call is working now. You can come in, ask questions. We have attorneys and CPAs online to get you the answers that you need. And if you're even ready beyond the information stage and you're ready to actually start saving those taxes with us, schedule a free strategy session. There's a link in the chat. You could also use this QR code. It's 30-45 minutes with a strategist where we'll talk about your goals, your investments, where you want to be, and how much tax you want to be saving. All right, how does one qualify for 0% capital gains in 2025? Starting in 2020, these people, they've done their research. So we've got the income thresholds, 0% long-term capital gains rate if your taxable income is $48,350 or less. If you're single and for married couples filing jointly, you get up to $96,700 or less. Just a fun statement here, however, taxable income is significantly lower than your gross earnings. So your taxable income is your gross earnings minus all your deductions. So maybe you're itemizing your deductions on a Schedule A. Maybe you're taking the standard deduction. But yes, typically your taxable income is lower than your gross earnings. Sometimes significantly, sometimes just a little bit.
Yeah, and that's one of the things that as we're going to see, the capital gains brackets is one of the few things you look at that's not based on AGI. So many tests that we look at are based on adjusted gross income. This is well down the list, and I'll go through actually where this comes on the return. But the last thing almost that you run into is taxable income with certain exceptions, and that's what our bracket for our capital gains is based on. That's what our questioner here is putting in there for these tax rates for 0%. So to get to the overall point here, it is, if you had overall income of under $48,000 and you're single, you would not pay any, you'd have zero tax on your capital gains. But what we got to watch out for is how does our tax return, how does it look at all the income we have coming up? And the phrase I use, it stacks it. Mm-hmm. So let's say we have some W-2 income, okay? Maybe we have, we'll put W-2 and other ordinary income. You could put another box if you wanted, or you put it in that box, either way.
We'll do ordinary
Perfect
income here.
And then we have our capital gains. We sold some stock or something like that, and it stacks on top of that, as Amanda's pointing out here. Now, if that total amount at the very last dollar of our capital gains is less than what we have here in our question, $96,700 if you're married filing joint, or $48,350 if you're single. If anything under that, then you're paying zero on that capital gains in that box. 0% there. That's how it works. Now, what if we go $1 above? Well, that $1 above, everything's still zero there in that first box, but that $1 above is going to be at 15%. Okay, that's the next bracket. And that's a very large bracket. It goes all the way up to like $600,000 for single, I believe it was.
That's where most
oh,
people
excuse
are
me.
falling.
Yeah, apologies. 533 for single and 600,000 married filing joint. So yes, you're right. Most people are falling in that 15% bracket. Now, with that in mind, once you understand the stacking and how it goes, I think it becomes much more easier to understand it. And so how are you going to do it? Well, you're going to try and keep in those boxes down there, and that's where you're going to get your tax savings. Now, the way it orders, just so you know, and I can even give you, if you ever look at your 1040, line 9, you're going to have your total income. That's, again, that's probably what they're referring to as gross earnings here. Line 11 is going to be adjusted AGI, which we use for so many other tests. AGI is always being thrown around in the code, but that's line 11. Line 12 is now going to be what Amanda talked about, if you itemize your Schedule A or your standard deduction. That's going to be line 12. And then we get line 13, something that doesn't hit all this. It's called QBI, Qualified Business Income Deduction. That's going to be if you have an S corporation, some flow-through entities where you have some income coming in, or maybe a sole proprietorship. Lastly, all that gets to line 15, that's your taxable income. I go through that process to show you this is exactly what we're referring to, the difference between gross earnings and taxable income. It's that last line that we're looking at to determine our bracket for our capital gains. And there it is.
So the value or the income or the gain you've made from selling that capital asset is included in that calculation.
Exactly. Now, jumping all the way back, we talked about our vehicle. What if we had that business, we had spousal income on that one question, we get that vehicle, and all of a sudden it can drop us down here, and we had some other capital gains on our return as well. All of a sudden, that's tax planning, where we can drop into these lower brackets and take advantage. Not only did we get a fantastic vehicle, we got a nice deduction for it, and maybe it got us to where we had zero capital gains, or maybe we were in a higher 20% capital gains, and it got us down to the 15% bracket. So that's tax planning. That's the essence of what we do. And this is a great example with all these questions you guys threw at us. We were able to walk through that and pull it all together really nicely here.
Yeah. All right. I invested in an ATM syndication. It was a Ponzi scheme, and all investment was lost. The K-1s I received for previous years were fraudulent, of course. How do I file my taxes for those years that I received a fraudulent K-1? So what's a Ponzi scheme? I mean, how many of you out there remember, what's the big one? Bernie Madoff.
Bernie, yeah.
That's the big one in my lifetime that I remember.
Yes. And when we talk about Ponzi scheme, there is kind of like the social definition out there, and then there's what the IRS calls it, okay? This is, in many regards, a fortunate provision by the code, by the IRS. They wanted to make it easier. They know the hardship that this kind of thing requires or brings upon an investor. So they wanted to make it easier, and they did. They came up with a revenue ruling back there based on Bernie's activities to try and make it easier and better for the taxpayer. If you don't meet the definition of a theft that's going on, that's a Ponzi scheme. You as an investor, you gave money to somebody, they took that money. Maybe they did it to pay for other investors and show them fake income or something like that. So I pay $100 in, they give it to Amanda to show profit that she's making, or maybe they take money from Troy or somebody, whoever it be, but really there's no gain going on. It becomes a very tight web of lies and things of that and deceit. If we didn't know how to do all that, this could be a capital loss, and you're limited to $3,000 every year potentially. So the IRS said that hurts. And so let's come up with a formula that maybe allows people to kind of avoid all that pain a little bit and get an ordinary loss, which will offset against any income on your return. So they come up with this revenue ruling about the Ponzi scheme, and we have two different piles, if you will. We have what's called the safe harbor, and then we have a non-safe harbor. And they do give you the option, but it's kind of go at your own, your own understanding and your own choice, and make sure you understand the rules. So you definitely want to talk to a tax professional on this. The safe harbor approach, the idea was, well, we'll go ahead and we'll automatically assume it was a theft. As long as you gave money to somebody and it looks like they took it and used it to pay other investors and took other investors' money to pay you back, et cetera, and there was really no investment strategy going on here, well, we'll let you under certain circumstances go ahead and deduct 95% of that investment. So let's say you put $100,000 in, you could deduct 95 immediately as an ordinary loss, no problem. Again, as long as you meet all the criteria. if you're not going to sue another third party. They say you were the direct investor and you're not suing anybody else, then you get 95%. 75% can be deducted immediately as an ordinary loss. If maybe you are going to go after another third party who got you into the investment, it's not the original investment scheme, but it's someone else. Well, then they say you can deduct 75% if you have that third party. Now, you have to be it has to be a qualified investor, which means, again, you're a person who specifically put cash. It's you directly. It's not your maybe your Schwab account or something like that that did it. A qualified loss means there has to be charged with a crime or something like that. It has to be deducted in the year of discovery. That would be the year that they did indict, or there was a complaint about that, and now you're aware of it. That's the year you have to take the deduction. This is critical for the safe harbor, that you must do it that year, and that ties into our question a little bit here. So you got to do it that year. And for the amount of the deduction, the calculation, if you have, let's say that you put money in year one, and the fraudulent conveyance comes back that they gave you a K-1 saying that you earned $10,000. You had to put that on your return that year, that you've got the K-1. Now, you didn't know any of this was going on, so you paid tax on that. Well, that's not very fair. No, it's not. But what the code says is that you can get this fictitious income. You go ahead and add it to the amount of your investment. We call that investment basis. So now we put $100,000 in. We paid taxes on $10,000 in a previous year on a K-1. So our loss becomes $110,000. We would take 95% of that immediately under the safe harbor. Okay. So those are all critical steps you want to be aware of, and that's how we would handle it in this situation if we took the safe harbor. Now, they mentioned here about filing taxes for all those years, or maybe they want to go back in a minute. Maybe they don't want to take the safe harbor. Safe harbor allows you that option, and I'm just going to correct us, that safe harbor 75%, we want to move over to the left side. That 75% is still safe harbor. It's just that you're going to sue a third party potentially. So we just want to get that over there. There you go. Non-safe harbor says you can basically, if you can prove the theft, which is one thing, you're gonna have to have attorneys for this, and now you get into the criminal code, and it may depend on the state you're in, so it becomes much more intricate. That means lawyers, that means more expense, and so they really try and push you to the safe harbor, but they're not going to handcuff you. If you want to do the safe harbor, you take the gamble, if you will, that you're going to be able to prove there was a theft, that you actually never received any income, actual investment income, that it was fictitious income, things like that. And then you can go ahead and in what we call open tax years, you can go ahead and back and amend, and you might be able to take the full $110,000 in this case as a deduction. This allows you a little bit more flexibility. But there's a lot more. While it's easy to say you got to prove the crime, and easy to say that you have to prove that you actually had fictitious income, it is far more difficult to substantially prove that in a court of law. Whole lot of a different situation here. So again, non-safe harbor is really not advised. We want to get into that safe harbor, but non-safe harbor does give you the flexibility that you're not necessarily required to put it all in the year of discovery. You could go back to previous tax years, do some amending. And on open years, that is, which we say is 3 years. So there's a little more complexity to it. We're going to advise people to go safe harbor. And in that case, this money you had on the previous K-1s, it would go into that pile of your investment, which we call fictitious income. And that's where you would take the deduction. You wouldn't go back and change your previous return. You're just going to recognize it as a loss in the year of discovery. And so that's kind of the difference we have going on there.
What percentage do I get to deduct under the non-safe harbor?
Non-safe, whatever you can prove, that's all a loss. So you could do,
100.
yeah, you're going to.
So if the difference between the 95 and the 100 is substantial, maybe you're putting in the extra work to do the non-safe harbor.
Yeah, but you definitely want to walk through this and make sure you have all your ducks in order, in a line, because if something got messed up, if you're past the open years, if you weren't able to actually prove a crime, if you weren't able to actually show that you didn't receive any income, if you can't prove that it was fictitious income, I mean, that takes a lot of, if you ever worked on huge cases, I worked on a mammoth one, over 10, it was something like 100 million documents that we had to go through. Oof. And I'll tell you, that takes years. It just becomes a big competition of a lawyers, they're going at it. You're going to have a forensic accounting going on. There's a lot to it.
Expensive.
But you're right. If you want to do that, you're absolutely right. It would be the way you'd want to go then, but it may not be worth it. So there you have it. So again, the lost, the previous years of fraudulent K1s, that income, safe harbor, you would just add that onto the pile of your loss.
So this question is saying, how do I file my taxes for those years that I received a fraudulent K1? So to me, this makes me think that the person hasn't filed their taxes for those years yet. So under the safe harbor, they would file their taxes as if that income was included and then deducted, or would they just not include that K1, fraudulent K1 income at all if they haven't filed yet?
I think that would be the pathway. You'd go back and file the K1s that you had, knowing that there's fictitious income, and then you would try, and then in the year of discovery you're filing, you're going to combine all of that. Now, we really get into the weeds here. The IRS could come back and argue, well, those K1s that you just filed, you now know that they are wrong. So you could get, this is what I'm saying, you want to really work with somebody and sit down with them to go through that and make sure that you're not giving up any rights by taking one path or the other. If that were the case, and the IRS might argue, look, that K1 we know isn't legit to begin with, if you haven't filed, well then maybe we have to go non-safe harbor. But you have other pitfalls potentially there as well. So you really have to sit down and talk with some people who do tax litigation and things like that.
The timing of where you are in terms of the filing and where they are in terms of, you may think, oh, this is a Ponzi scheme, but unless it's been deemed an actual legal Ponzi scheme by the feds or by the IRS and the person's being charged for the crime, then it's going to be a lot harder to fall into that safe harbor.
And great point. And we had this question, I want to say, I don't know if it was the last a similar question, not this question, but about Ponzi. And usually what I see from clients is there will be a letter from the FBI that they get. And this is how they find out about it, or from the Treasury Department, what have you, usually maybe even state government or something like that. So often you will have been contacted and have that kind of thing, and that puts you on discovery notice that, hey, that's a year of discovery, we got to get moving on this. But there's pitfalls, for both. The safe harbor was just made to be hopefully a little bit easier and, kind of streamline people into a process so they could get that ordinary loss. Again, going back, if we didn't get that theft, if we, for some reason we can't call it theft, it becomes a capital loss most likely, and we're limited at $3,000.
$3,000.
Yeah.
Which isn't going to be significant enough.
No.
All right. What are the tax implications of doing a deed in lieu for a timeshare? So a deed in lieu, also deed in lieu of foreclosure, it's basically the alternative to having your property foreclosed upon. Formal foreclosure requires going through a court process. So instead of going through that rigmarole, you're basically saying, hey, I owe you a debt. Here's my property, in this case a timeshare. Here's my property, and you won't come after me anymore for the difference, and they now have your ownership in your property. So the tax implications of that, what's really happening here is the debt's being forgiven, right?
That's exactly right. And of course, the IRS has a term for that. Discounted debt. You get taxed on it. So whatever amount, if you get $50,000 forgiven, discharge of debt, cancellation of debt, it's going to be an ordinary income. And so there's our tax implication. I give over my deed, they take away the debt, and so I have to pay ordinary tax rates on that. There are a couple of situations where maybe you wouldn't have to on that. That's going to be a situation where if maybe before you did the exchange, you were insolvent, you had more liabilities, total liabilities as an individual than you did assets, that possibly could get you out of that, or at least a little bit less of the debt income. Or possibly if it had been discharged earlier in bankruptcy, if you'd gone for formal bankruptcy procedures, then that might as well. Those are things that you'd have to look at a little bit more in depth, but they are ways around it. There's another area where you have discharge on a qualified personal residence, but we don't have that going on here. A timeshare is not your personal residence, so I don't think that's an avenue there.
And this COD, cancellation of debt, applies to any debt you have. So if you take out a business loan and default on it, and then you negotiate to pay off 50 cents on the dollar for that loan, that other 50 cents that you owed, that's ordinary income to you, so you're paying taxes on it. Obviously still better than paying the actual loan amount, but depending on your taxable income, it's not quite the benefit that sometimes you think it is. So it's going to apply to business loans, credit card debt, Student loan debt, really anything.
Yep. But as you point out, it does get you around, this exchange in lieu of foreclosure gets you around the formal proceedings, all the attorneys and all the people you have to pay in the court system, the time and anguish,
Save attorney's fees.
right? So we
We're
get
the
that.
only attorneys who try to help people save attorney's fees.
Save those fees for paying the tax on the cancellation.
Right.
So,
All right, our final question. What happens to your real estate if and when you move outside of the country? Is it deemed a disposition? So what's a disposition is what?
So, first of all, normally when we think about real estate, that's selling it. You sold it, you did a 1031 exchange or something like that, you gifted it away. But really what we're looking at here, I think, is something deeper. And Amanda pointed this out when we were talking about before this show, well, isn't there something that happens if you just I'm leaving the U.S.?
Yeah, if you're just moving and relocating, becoming a digital nomad, nothing happens. If you're a U.S. citizen, you are taxed on your worldwide income, regardless of if your assets are in the U.S. and other countries, regardless of if you are in the U.S. or other countries. You can get a foreign tax credit depending on the tax treaties in the particular country you're in. So what is it, like up to 90,000, close to 90,000 of income that you receive in a foreign country where you're likely paying tax on that as income, but then you're not doubly taxed in the U.S. So if you're relocating, you're most likely not getting doubly taxed. Your assets are still your assets, but you are paying tax on your worldwide income. Now, if you are expatriating, so if you are renouncing your U.S. citizenship, then that is when this sort of idea of a disposition, it's not technically a disposition, but comes in. And so what happens on the day you expatriate, your assets are treated as if you sold them all, and you will pay tax based on that, with some exceptions. You still own the assets, but for tax purposes, for that sort of, it's not even going to be a final tax return unless you actually do sell the assets but for the benefit of not being a U.S. citizen, you get a humongous tax bill. So all of your assets are treated as if you sold them. What are the limitations there, Elliot?
Yeah, so it's often referred to as an exit tax. And as Amanda points out, well, I still have my assets. Well, yes, but you're treated as if you sold them. And the worldwide assets, not just your U.S. assets. So you get this exit tax. How's it all come about? Well, there's basically three criteria, if we can get under it. But if you meet any of these, if you have over $2 million of net worth, basically, well, then you're going to get hit with the exit tax. In the last 5 years, if you had over $201,000 of taxable income in the last 5 years, well, you're going to get hit with the exit tax. Or if you really weren't up to date on your federal returns, you have some federal obligations out there, you didn't maybe did all those tax returns, maybe got hit up with a Ponzi scheme and didn't file your returns or something like that. If you're not in compliance, you could get hit with the exit tax. So any of these three criteria are going to get you into that unfortunate situation of the exit tax.
The $201,000 taxable income, is that for the previous 5 years?
Yes,
is that
5 years.
Cumulative or each year?
What I saw was that each year you're over 201,000.
So it's possible if your net worth is less than $2 million and you made less than $200,000 in the last 5 years and you don't have any outstanding tax debt, you could expatriate and not have to pay the exit tax.
Yeah, always want to check, make sure nothing's missing or whatever with your tax professional before you do this. But that's the deal. But there is also an $890,000 exemption on that capital gains. It's treated. Again, you're treated as if you sold everything. It's capital gains tax, and you do have $890,000 of exemption for 2025.
So the first $890,000 of that deemed distribution is not taxable.
That's correct.
And most people aren't thinking of renouncing their U.S. citizenship. You can go to another country, you can live there, you can never come back to the U.S., and you can often either have some sort of visa or resident status there or have dual citizenship. That's it, dual citizenship. People who are, this is more to capture people who are very high net worth, who are thinking, oh, I'm retired now, I'm just going to go off to the Cayman Islands and never be in the U.S. again and never have to pay taxes. That's just simply not going to be the case, because if you still have U.S. source income, guess what? You're still paying income tax on that every year anyway. So you're just kind of increasing your tax by trying to
They
get out of here.
They've kind of thought of everything, haven't
Yeah. Oh, darn. Those IRS
Curses.
people. Curses. So just go and relocate. Go visit.
Yeah.
Don't get hit with this exit tax.
Yeah,
Continue to be an American.
Things you don't want to pay, probably. Yeah. They
All right.
spank you hard on that one.
Well, we're going to wrap it up. For those of you who are listening on YouTube, or for those of you who are in our Zoom, head over to YouTube, smash that subscribe button, like our videos. If you subscribe, you'll get a notification each time Tax Tuesday comes out. It's a live show. We're here every other Tuesday throughout the whole year. Elliot's here most of the time. I'm here once a month.
Yep.
We have a good time.
But we have a whole team here, remember?
We do have a whole team. Also, subscribe to Clint Coon's channel, Asset Protection. Clint and Toby are the two founding partners here at Anderson. Finally, again, join us in Vegas for our tax and asset protection workshop, June 26 and 28. Tickets are only $99. Bring a friend. Make a friend when you get here.
Yes.
Not that kind of friend. Get your minds out of the gutters. Also, join us Saturdays for our one-day webinar. If you want a little bit more of a bite-sized chunk, we have our tax and asset protection plus estate planning workshops every Saturday. And if you're ready to become a client, schedule your free strategy session. Sit down with a senior strategist, talk to you about your goals, your assets, the things you want to be doing with your life, and how much tax you could be saving there. Finally, if you want to send in your questions, email them in to taxtuesday@andersonadvisors.com or visit us at andersonadvisors.com. And with that, how many questions did the team answer?
I lost that page, so I can't bring it up. I'm not sure how many we got. But I can say Patty, Dutch, Harry, Jared, Jeff Stolken, who else we got? Marie, Rachel, Ross, and Troy were out there just killing it. And I'm sorry, I don't know how many questions.
Yeah,
85.
Yeah, 85 questions. So
Very good.
thank you guys so much for joining us. Thank you to the team in the background for answering all of those questions for us. And join us next time on Tax Tuesday. Take care, everyone. Bye-bye.